Hello, everybody. Welcome to Jazz After Dark. I'm Dustin Tibbits, financial advisor here with Jazz Wealth, and tonight we will be sampling Hakata. I feel like we had this one. 10-year-old sherry cask whiskey. Should be getting some oak, raspberry, walnut, earthy, sherry, and strawberry. Okay. I get the oak. Maybe the raspberry. Oh, that's pretty good. Yeah, no, I get that. I don't know about the sherry. Maybe a little bit. If you don't know, we get these little sample vials from Flaviar. We are not affiliated with them, but it's pretty cool. You get to test out different things before you buy them if you want to buy a bottle. I don't know. I would say that's pretty good. Maybe more of a sipping something, very dessert-like. But you're not interested in that. You're interested in this market. The heck is going on out there? Well, actually, a lot of good things and a lot of sort of cracks under the surface things here. I realize that some of you are excited about the market falling, and some of you are like, oh no, what's going on? So I want to share some things that I shared in our Notes from Jazz email. It's an email that goes out every week to our clients, where instead of just telling you the basic stuff, we try to give you some of the geeky, more detailed stuff so you have more of a well-rounded look at things here. Let us take a look. One thing that I found kind of fun, this is no joke, by the way. The red line is COVID, right? So leading up to COVID and then that peak, and of course, the nastiness that came from that. Did you know that the peak of our market now, since before just this recent pullback, and the COVID peak happened on the exact same day, both on February 19th. So this could look a little scary to you, right? You go, ooh, well, look what happened. Well, that's a global pandemic. This is a global trade war, all right? So we were kind of illustrating that in the email going, this is the fastest we've fallen 10% since COVID, but this is most likely not something that's related to COVID. The other thing I like to share, just sort of oddball things here before we get into it. The other thing I wanted to share was, if you look at Obama's first term and Trump's second term, they're performing quite the same, actually. Obama had a bit of a choppy start to begin with. Everything was fine, and then all of a sudden we started falling apart. You get into the Obamacare and all that, new president type stuff. And so he bottomed out about 33 days in before we saw the rally. We're a little bit further than that, but if you count Friday's rally, if we assume that's the low, you're pretty close in participation there. So I made a joke in our newsletter that, hey, they don't like each other that much, but that's something they can agree on right there, is they've had about the same performance. So just a couple fun things to get things started. Let's try that again. It makes you, it's kind of like having a little bit of candy. Kind of made you want to go back for some more. So that's pretty cool. Okay. So how do we answer the question, is the stock market going to fall more? Nobody really knows, right? But we can use some data here. So we did a little interesting thing. We said, okay, let's go to every single year since 1953, and let's find the biggest pullback from highs. There may have been multiple pullbacks throughout the year, but we said, we want the biggest one. And so each one of them is plotted in blue here. That's every single pullback from highs. Then we took the median and said, well, median declines about 10.5%. Well, wouldn't you know it? That's exactly where we're at. So right now, we wouldn't say that this pullback is anything odd. It's not scary. It's maybe not fun, but it's not anything crazier than the median pullback. It could get worse, of course, but for the moment, that's what we've got. Now, let's say we pull back another 5 or 10%, and we get towards that 20% mark. Well, would that be odd? You go back over here and you say, well, here's 20%. Okay, that's starting to get a little odd. It can happen, and it obviously has happened through COVID. That's your COVID drop there. But that would be sort of odd. Now, would you panic during that? Some of you, yeah, right? But you would go, no, because that pullback is odd. It's not normal, and therefore it should be buyable at that point. So isn't there like a part of you that says, if I have available cash, which we do in our portfolios here, we've had cash for a little bit. So as the market pulls back, we hit the 10% mark and we go, okay, put a little cash to work. Let's see what happens. Maybe we'll put some more to work. So as painful as it might be, we're kind of actually cheering for more of a pullback because it makes it outside of the median, right? It makes it a little bit different here because now we have less and less scenarios. In any one of these scenarios below the red line, did the market not recover? No, not one of them. In every single case, the market recovered. So if we had our way, we want to buy as cheap as possible. And that's a mindset that can be difficult, especially if you're closer to needing the money or closer to retirement, whatever it may be. So then you go, all right, well, maybe I do want the market to pull back a little bit more. I'll suffer it. I'm 42, I'm 45, I'm 55, whatever. Got some time, maybe I'll work this out. So if the market does pull back more, and regardless, let's say it pulls, this is it, and that's all it does, what kind of bounce could we expect? So we took the inverse of that and we said, okay, of all of these declines that we had, this one, for example, when this one happened, what was the ultimate rally from that? When this one happened, when this one, and so on. So we took a look at that and said, okay, well, what is that? Well, the median gain from the year's largest pullback was 20.6%. Doesn't that sound pretty good right now? Like, okay, I'll take 20.6%. I like the sound of that. That works for me. I'm not saying we're going to get 20.6%. And one of the reasons is we had 2 back-to-back years of 20% gains. We have not had 3 back-to-back years of 20% gains. So that would be odd if we just rallied up here, turned positive for the year, then, or got a 20% gain and then actually went to 20% total performance. I don't think you can expect that, or at least there's nothing that says you should expect that. But what it does show is these pullbacks have always been viable. Not one of, well, it's not possible, but none of the pullbacks turn negative. But look, that's the 10% rally off of lows. Almost every single case besides 1, 2, 3, and 4 rallied more than 10%. So you're getting, well, at least at the moment, you're getting this pullback here. And although a 10% pullback and a 10% rally doesn't bring you back to whole again, almost does, right? You need 11% rally. So you go, well, if I'm in it for the long run, I want to be a part of this pullback here, right? So will the market fall further? Probably. If you look back to Trump's first term, it was more volatile than Obama's term and Biden's term. So we know through his actions and his what he's trying to do, it does create more volatility. It's no different than if you have a big corporation that gets a new CEO, and this guy's a little more hard-nosed than the previous guy, who's going to create some concern. So for that reason, I think, yeah, the market has room, and it's still plenty of time in the year, to pull back more. But if it does, it's a gift. We want that, right? If it doesn't pull back, fine, okay, it's less exciting, I think. But we now have things to show that there are numerous reasons to believe that a pullback beyond this point would be, a viable reason to look at the market. Now, I put in our notes from Jazz, right now, I don't see this as a back the truck up and dump all your money into the markets. So in our portfolios, they're expense-free, by the way. We don't charge for those. So in our portfolios, we've got that sliver of cash over here. If we do get the pullback, little cash. I like averaging into that, knowing that anything beyond this point is getting odd, right? So a bit of a mindset there, a different way to look at it. I hope you enjoyed. Here's tonight's video, Hakata, 10-year-old sherry cask whiskey. I'm going to go fruity. I'm not sure I would have picked out, sherry. I would have probably said raspberry, but it's good. I would most likely not buy a bottle of this. This is just not my thing, but if you like that sort of fruity whiskey, congratulations. You might have just found something. Hey, check us out at Jazz Wealth. If you like it at Work with an Advisor, we work with clients of all sizes all over the United States, and we were ranked the 66th best advisor in the entire country. There are tens of thousands of advisors, so we'll take 66. Sounds pretty good. All right, see you.